All right, do me a favor. If you have a traditional IRA or a traditional 401k account, just think about roughly what the balance of that account is. If you have a recent statement, you can find it there. And there's a hard truth that I need to tell you today. A portion of that does not belong to you. It technically belongs to the IRS. Or if you live in a state where there's state income taxes, a portion of that is owed to the state as well. That's where a Roth conversion strategy comes in. You have the ability to decide when to move funds from the pre-tax account either into your bank account or into the tax advantage Roth IRA. Now, in today's video, I'm going to discuss something I feel is often overlooked when it comes to Roth conversion strategies. You've probably heard the standard advice: pay the tax from outside money, never from your IRA. There's just one problem. This assumes that you have outside money outside of your IRA or traditional 401k. If you're like a lot of people, you might not. You spent decades saving diligently into the 401k or another employer-sponsored retirement plan, and now you're looking to make the most of those savings. So today I'm answering a question I feel often gets skipped over. Can you still move money from a traditional IRA into a Roth when the IRA is all that you have to pay the taxes? There are some important considerations to keep in mind, but generally, yes, paying taxes from the IRA itself does not fully negate the benefits of a Roth conversion strategy. The real question is how much to convert and when to stop. I'm going to show you a live comparison of the same retirement with and without a Roth conversion plan. First, let's make sure you're in the right place. You're in your late 50s or early 60s and retirement is close or already here. Nearly all of your savings are in a pre-tax or a 401k account. If that's you, then this whole video is yours. Before any numbers, I want to kill a feeling that you might have right now, and that's that you did something wrong. You did not. You did not do anything wrong by saving this way. It's about maximizing how you access those funds moving forward. You followed a very common path for decades. You grabbed the company match, you lowered your current tax bill. You did exactly that every paycheck for a while. Now, you might have some savings outside of your retirement account, but not enough to cover the future tax liability of those withdrawals. That's completely okay. Let's start with what a Roth conversion actually is, and the one idea I want you to carry out of this video. Then the standard advice: always use non-IRA funds for Roth conversions, and why it leaves out some people like possibly you. The real cost of doing nothing, the part nobody itemizes for you. A live side-by-side of the same retirement with a plan and without one, and 3 practical pieces to make it real, plus 1 warning if you're under 59 and a half. One more thing before we get into it: if you'd rather have someone run a scenario tailored to you, that's exactly what I do. The link to start that process is in the description. Here's the main idea. A Roth conversion is when you take money out of a pre-tax account, a traditional IRA or a 401k. The amount you move gets added to your taxable income for that year, so you pay the income tax on it now. Once in a Roth, assuming qualified withdrawal rules are met, those funds can grow tax-free throughout your life and even pass on to your heirs tax-free. Here's how I want you to look at your pre-tax account from now. Whatever the balance says, part of that money was never yours. It's the IRS's share sitting inside waiting. The questions are: when do you pay it and at what rate? In retirement, your taxable income becomes more controllable than you might think. The good news is you do have control over how much tax you pay over your lifetime, but only if you take that control and plan it on purpose year after year. The math behind this standard advice is correct. Say you convert $100,000 and withhold the tax from the IRA at 22%. The IRS gets $22,000 and only $78,000 actually lands in the Roth. Pay that same tax from savings or not from the IRA instead, and the entire $100,000 arrives in the Roth. Same conversion on paper, very different amounts that are in the tax advantage Roth IRA, getting that compounding tax-free growth for years. There's also the fact that non-deferred investments or normal brokerage accounts have an ongoing tax drag as they incur taxes for interest, dividends, capital gains the year that they occur. So if you have a brokerage account, using brokerage funds when available can be the preferred method, because you're not only allowing more into the Roth, you're actually reducing that ongoing tax drag in that brokerage account. So put more simply, paying from outside money essentially lets you reduce a current account with tax drag, plus gets more money into the tax advantaged Roth account. So you're probably thinking, so paying from the IRA burns part of the conversions. Why would I ever do that? And that totally makes sense. If I didn't do this for a living, I might think the same thing. But when you do have no outside money, your choice was never IRA versus outside money paying for the taxes. Your choice is paying the taxes from the IRA and planning when you pay those taxes, or doing nothing at all. So let's let's compare you to yourself instead of someone with a brokerage account. Doing nothing might have a price tag of its own. At a certain age, the IRS stops waiting. Required minimum distributions, or RMDs, are mandatory withdrawals from your pre-tax account every year, whether you need the money or not. All taxable unless distributed as a qualified charitable distribution, which is something to keep in mind if you're charitably minded. Picture a couple with $2 million, all pre-tax plus 2 Social Security checks. When RMD starts, tens of thousands of forced income stacks on top every year, no way to turn it off. Our goal with planning is to give you more flexibility. Or a big expense shows up, a roof, a medical bill, a down payment for a house. If everything's pre-tax, the only place to get $60,000 is a taxable withdrawal stacked on top of your other income for that year. Whatever's still in that account when you're gone becomes pre-tax for your beneficiary as well, which can often be right in your kids' highest earning years. The tax you never plan becomes your heirs taxed at their rate. And there's Medicare IRMAA, IRMAA is an extra fee on top of your standard Medicare costs once your income crosses certain lines. Big forced withdrawals can be the difference of thousands paid for Medicare. So when you hear IRMAA, just think extra Medicare costs. Here's what a plan does mechanically. Every year we decide where your taxable income is going to land because we have that control. The target is often either the top of a specific tax bracket or just underneath an income line where Medicare starts charging you extra, or IRMAA comes in. Then we will fill up to that target each year. If a year gets expensive and your spending uses all of the room, then we convert less or nothing for that year. The target stays put, the conversion flexes around your life. So we don't convert the same amount each year, we target the same income level each year. If you have all or a majority of your retirement savings in pre-tax, you have a large amount of control over your lifetime tax bill. The earlier you start, often the better, and filling your income to a certain line on purpose is where that control comes from. Now I'm going to show you a couple of different ways of how we do this, how we can plan this out. So this is a tax planning software that I use called Holistaplan. Now this allows us to upload your tax returns and then build out future tax returns in the future, and also has some cool tools that I think visually might help you picture when I say target a specific income. What does that mean? How do we find that target? And then how do we go about doing that? So I'm just looking at, this is the same example. Say it's a family, they have $2 million, all of their savings in pre-tax. They don't have a bunch of outside savings elsewhere. In this scenario, I have them getting $4,000 each a month. And then just if that's all they were to take as income, then they would do a federal tax withholding payment of $4,000 each, and that would be their tax situation. Some might say that's a pretty good situation to be in. If I scroll down, so it's $104,000 of IRA distributions, just put in a little bit of taxable interest. They might have a little savings account. Other than that, no other income. Now, if we look at where that puts them right in the 12% tax bracket. And so when I say opportunities to fill up or take taxable income on purpose, right here, that 12% tax bracket looks pretty favorable. It's very unlikely that they're going to be able to pull all of their IRA money out lower than the 12% bracket. So we're going to, on purpose, most likely fill up the 12% bracket for sure. Now, this jumps to the 22% bracket, and these lines right here show those extra IRMAA costs, those extra Medicare costs. And so when we're looking at, should we do a conversion in the 22% bracket before IRMAA becomes relevant for them, that might be the next question. And just looking at the situation of once they're on Social Security, then IRMAA is also going to be affecting to them. What I did here was I took the exact same scenarios, inflation adjusted their income, have them both turn on Social Security, and then reduce their IRA distributions by the amount that they're now getting on Social Security. So their income is essentially the same. They're just getting more money from Social Security. Now, the goofy way that Social Security is taxed is now, even when they're in the 12% bracket, each dollar that they earn is bringing in another 85 cents of taxable Social Security benefits. So really their effective rate, marginal rate, is the 22.2% tax bracket for them, even when they're in the 12% bracket. They see a little bit of room where they have the 12% bracket, and then they're in the 22% bracket anyways. So when we're looking at this, projecting out their future situation, 12% seems like a no-brainer. 22% is where a lot of money is going to get withdrawn from anyways from that traditional IRA, any additional withdrawals over their normal spending. So that's where we want to look at what a lifetime conversion strategy can look like. Now, I always say to use these projections, to look at them with a grain of salt. There's some incredible capabilities piece here, but essentially what this is doing is it's taking one income target and applying it through a projection through the remainder of, this is a hypothetical example of a couple 60 years old with $2 million. What would save them the most money? So we have to kind of scroll up. This is the average tax rate, total taxes paid, total net income, total net worth, so total legacy that they leave. So now when we look at these different areas, it's pretty clear if you do nothing, average tax rate about 11.7, total taxes, net income. So that's kind of the baseline, do nothing. Now, when we start looking at the different conversion strategies, just IRMAA 1, filling the 22% bracket, now we can start to see not only the average tax rate going down, but the lifetime total taxes significantly dropping, and in turn, total net income for the plan going up and the total legacy going up. Now, I use this to see if it makes sense to do a conversion strategy over and above the obvious, which would be in the example I showed, the 12% bracket. Now, this is saying with the amount of money that they have growing in the pre-tax account, they're going to be forced into a situation where they're going to have both their social securities on, they're going to have a high RMD, and that's going to force them into a higher tax situation, potentially higher IRMAAs for the rest of their life. But the limitation is that we're not just going to pick one target and do that for the rest of their plan. Things are going to change. If IRMAA doesn't affect them, then we're not going to worry about IRMAA, which wouldn't affect them until 63. So I would say a most likely scenario, we might consider the 22% bracket or the 24% bracket while IRMAA is not affecting them, just to depending on how much flexibility we want to give ourselves by removing money from that pre-tax account and allowing that into the Roth. So it's all going to depend on the person's situation, but mathematically we can see an advantage in a Roth conversion strategy, even though the taxes are being paid out of the IRA. That's the only asset that I input into this program. So that just gives you kind of an idea of how we can look at your specific situation and come to the conclusion of what conversion strategy makes sense for you. Again, this is a hypothetical scenario. This is not tax or investment advice and should not be construed as such. Now that gap says it all. I mean, there was hundreds of thousands of difference in the projections if this couple did a Roth conversion strategy or if they didn't. And they only have IRA funds to pay the tax liability on it. But same couple, same money, same markets. The only thing that changed was where their taxable income landed each year. Now let's make this practical. First, take an honest inventory. You may or may not have funds outside of the IRA to cover the taxes owed. The conversion tax can often get covered from cash savings beyond the emergency savings fund or from an inheritance. It might make sense in your plan to cover some of the conversion taxes from your IRA and some from outside sources. It all depends on your individual situation. And second, know when the answer is do not convert. The point is to maximize your after-tax wealth. Some people like the idea of converting and looking at the Roth IRA without that nagging feeling of a piece of it being owed to the IRS. However, the point is to spread your tax liability out strategically. Over-converting can have the opposite effect and actually lower your after-tax wealth. This is why I revisit the strategy every year with my clients before we make any decisions. There's also market movement, life changes, tax law changes, etc. that all need to be considered on an ongoing basis. Third, one hard warning, if you're under 59 and a half, the conversion itself is fine at any age, but withholding the tax from the IRA before reaching age 59 and a half could trigger an early withdrawal penalty of 10%. Most likely it would. Now, a lot of Roth conversion plans typically come down to big conversions post 59 and a half and pre-Social Security, especially if, for example, someone retires at 60, like the example that I used. But again, I cannot stress enough, a Roth conversion strategy needs to be tailored to your life, no one else's. And lastly, the part that isn't math, because I watch it stop more people than any projection or number does. Writing a real check to the IRS on purpose, sometimes in the tens of thousands, feels bad. So here's the reframe. A plan lets you spread out that tax liability strategically. No plan means you have less flexibility and the tax rate that you pay is picked for you. I'm not an advisor that believes in rules of thumbs, but rather the value in understanding your personal situation and what's important to you. I take interested people through an educational review process that touches on retirement planning concepts that they care about. If you're interested in learning more about that process, feel free to check out the video in the top left of the screen, or if you're ready to meet with me, I'll put a link to schedule a time in the video description. And as always, money is a tool, knowledge is freedom, and planning is power. I hope you have a great rest of your day.